Perhaps the most noteworthy event that occurred in the month of August was the fact that Jerome Powell's speech at Jackson Hole gave some clues in terms of prospective monetary policy actions going forward. He made specific reference to the fact that labour market conditions have cooled from their overheated state over the past 6 months. And this can be seen on the graph as evidenced by the uptick in the unemployment rate that we have seen from the 2023 lows till the last data point. Also, you can see on the next chart that the employment cost index has cooled from its overheated levels, but is still quite buoyant on a year-on-year basis. So, the recent focus of prospective monetary policy decisions having an increased weight toward developments in the labour market likely set the scene for a federal funds rate cut at the next Federal Open Market Committee meeting. Also, a special mention was made to the fact that there is growing confidence amongst committee members that the inflation rate will indeed trend back to the 2% target while maintaining a relatively upbeat labour market condition by historical standards at least. It is important to note that it was also mentioned that there's sufficient policy manoeuvrability to respond to undesirable weakening labour market conditions going forward. So that also hints at the fact that we could have deeper federal funds rate cuts if labour market statistics actually meaningfully deviate from the committee's own projections. Not only are the movements in labour market conditions the primary focal point for the Federal Reserve's prospective monetary policy actions, but looking towards inflation statistics, as we can see on the slide, we've seen that United States consumer price inflation and producer price inflation have both surprised to the downside in the latest print, and they look to be trending toward its 2% target in the coming quarters. So a fine balance will need to be struck between the amount of loosening in prospective monetary policy as well as reigniting potential inflation prospects in the coming quarters. So the magnitude of easing will need to be just right in terms of getting a desirable 2% inflation target while keeping labour market conditions relatively upbeat. Elsewhere in the world with regards to inflation statistics, if we take a closer look at the UK for example, we see that CPI and core inflation statistics there are trending meaningfully off the highs that we have seen in 2022 and 2023. This is particularly important because this caused the Bank of England to actually recently slash the bank rate at their most recent committee meeting. It was a close vote with 5 members voting for a cut and 4 members voting for no cut, but indeed the monetary policy easing cycle has started, as can be seen on the slide, from a rate of 5.25%. Moving away from the UK, elsewhere to Japan for example, we see that the exact opposite is happening with regards to prospective monetary policy actions. In fact, the Bank of Japan is on a hiking cycle because of the fact that they are concerned of inflation prospects going forward due to the fact that wages have been increased amongst the highest that we've seen in the past 33 years amongst the largest labour union. Importantly, prospective monetary policy actions actually caused heightened market volatility, as can be seen on the chart with the Nikkei Volatility Index surging more meaningfully over the past couple of weeks, causing a bit of market jitters. Importantly, we have seen the Deputy Governor come out more recently to assure market participants the fact that any prospective monetary policy actions will not necessarily take place from a tightening perspective if this causes capital and financial market instability. So really to summarize the theme that we're seeing at this current juncture, we can see that the globe is indeed slowing from its overheated levels, but it is still in an expansionary state. As can be seen by the Global Purchasing Managers Index, we still have readings meaningfully above the 50 neutral mark, indicating that there is expansion in economic activity taking place. However, this has meaningfully cooled from its overheated levels. This is likely a desirable outcome for many central banks around the world to be able to ease policy dynamics in the coming quarters from already tight levels.